Economist Thomas Piketty, whose book Capital in the 21st Century has sold over 2 million copies, warned that the government's decision to cut corporate tax rate to 25% from 30% could be dangerous for India in the long run. Speaking to CNBC TV 18's Ronojoy Banerjee from Jaipur, Piketty said history showed that there's constant pressure on governments to gradually bring down corporate tax rates, which potentially increases the income gap between large corporate houses and small-medium enterprises. He also said that with global turmoil and tepid growth, the forces of inequality could only widen.
The risk that slowly, gradually, we tend to reduce the tax rate paid by the most mobile tax base, and then we increase only the tax paid by those who cannot move. So typically we increase consumption tax, we increase the tax paid by the middle class or the bottom groups in the population. Now I think this is a very dangerous evolution in the long run, because if the middle class or the small and medium-sized businesses feel that they are paying more than what the biggest corporations are paying or the top income or wealth group are paying, then there's a risk that at some point, the people in the middle or in the bottom will not want to pay. So if you want, the rule must be, if you want to build state capacity and adequate financing of public investment in education and health, the rule must be that everybody has to pay a fair share in tax. The main force to reduce inequality is the diffusion of education and knowledge, which also means that if you don't have this broad-based investment in education and knowledge, and this is an issue in a country like India, then inequality will remain very high, and in the long run can also be bad for sustainable and inclusive growth.